$6 trillion vanished. Why gold price and silver price crashed so fast. Explained. More than $6 trillion vanished in just 60 minutes. If you were holding silver at $121 or gold at $5,600, I'm sorry, but this isn't just a bad day. This is a moment that separates those who understand the markets from those who panic. Right now, somewhere in the world, someone is staring at their screen, watching their portfolio bleed, liquidations cascading into more liquidations, stop losses being hunted, leveraged positions wiped out, and all while the mainstream media tells you it's just volatility, normal market behavior, nothing to worry about. They are lying. What happened today was not random. It was not luck. It was a perfect storm of global forces, market mechanics, and human psychology colliding in one brutal hour. And if you don't understand it, your next crash will hit you even harder. But here's the thing. I've seen this before. Not years ago, not months ago, but recently. December 2025, the last 2 days of the year, the exact same pattern emerged. Sharp panic selling, cascading liquidations, sentiment at rock bottom. And then January 2026 happened. Gold rallied 30%, silver soared 65%, the biggest monthly rally in decades. So, is today the end? Or is it the beginning of something much bigger? By the end of this video, you will know exactly why this crash happened. You'll understand the hidden forces that move gold and silver, forces that 90% of retail investors completely ignore. And I'll show you the historical patterns that could tell us exactly what happens next. But stay tuned, because I'm also going to reveal one prediction with a specific date on the record. If you click away before I reveal it, you'll miss the insight that could turn this crash into your biggest opportunity yet. Welcome to the hidden economy. I cut through the noise to show you what is actually happening in the markets while everyone else is distracted. Hit subscribe now, because what I'm about to show you could save your portfolio. Let's break down exactly what happened today. January 29th, 2026, around 10:30 a.m. Eastern Time. Gold was trading at $5,600 per ounce. Silver was at $121 per ounce. By 11:30 a.m., gold had crashed to $5,100, and silver had collapsed to $108. That's $500 wiped off gold in just 1 hour. That's $13 wiped off silver in the same span. Put this into perspective. If you had $100,000 in silver at the top, you now have $89,000. $11,000 gone in the time it takes to binge a Netflix episode. And if you were leveraged using margin or short-term call options, your losses were magnified. This isn't just a phrase. Liquidations triggering liquidations is exactly what happened. When a price drops this fast, leveraged traders get margin calls. They're forced to sell to cover their positions. That selling pushes the price even lower. That triggers more margin calls, more forced selling, more liquidations. A cascade, a waterfall of red that wipes out weak hands in minutes. Those who bought at the top thinking gold at $5,600 or silver at $121 would continue to rise. Thoughts and prayers. Here's the part most people will miss entirely. This crash didn't happen because gold or silver are broken. They crashed because of something much bigger. Something called the DXY, the US dollar index. If you haven't heard of it, pay attention, because it's one of the most important things you can understand about precious metals. The DXY measures the strength of the US dollar against a basket of major global currencies: the euro, yen, pound, Swiss franc, Canadian dollar, and Swedish krona. When the DXY rises, the dollar strengthens. When the DXY falls, the dollar weakens. Here's the critical insight. Gold and silver move inversely to the dollar. Almost always. Not sometimes. Almost always. Let me explain. Gold and silver are priced in dollars. When the dollar strengthens, it takes fewer dollars to buy the same ounce of gold or silver, so the price in dollars falls. When the dollar weakens, it takes more dollars to buy the same ounce. Price in dollars rises. Think of it like a seesaw, the dollar on one side, gold and silver on the other. When the dollar goes up, metals go down. When the dollar drops, metals rise. They cannot both go up at the same time. They cannot both go down at the same time. Professional traders don't just watch gold and silver charts. They watch the DXY like a hawk, because when the dollar spikes, they know exactly what metals are about to do before it happens. Today, the DXY surged hard. Dollar strength hit metals like a hammer. That is the real reason gold and silver crashed. The next question is obvious. Why did the dollar spike so aggressively today? There are three primary reasons, each critical to understand. Reason 1, the Federal Reserve. The Fed has been extremely hawkish lately, signaling higher interest rates for longer. Higher rates make the dollar more attractive because foreign investors earn better yields on treasury bonds and dollar-denominated assets. That increases demand for dollars, pushes the DXY higher, and crushes metals. Reason 2, China. Industrial demand fears hit silver hardest. China's manufacturing activity is slowing. Output is declining. Silver isn't just a precious metal, it's an industrial metal. Solar panels, EVs, electronics, semiconductors all use silver. A slowdown in China sends traders running from silver. Gold also falls, but silver reacts more violently due to its industrial exposure. Reason 3, U.S. government shutdown risk. With a shutdown looming on January 31st, political uncertainty triggered risk reduction. Traders took profits and reduced exposure to volatile assets. This isn't the sole cause, but it was the trigger for panic selling. These three forces collided simultaneously. Fed hawkishness, China slowdown, and U.S. political uncertainty result $6 trillion evaporated in 1 hour. Most retail investors think gold and silver move together, same direction, same intensity. That's wrong. Silver is gold on steroids. When gold moves 5%, silver moves 10-12%. Gold up 10%, silver up 20%. Gold crashes 8%, silver crashes 15 to 20%. Today's crash, gold fell 9%, silver 11%. Same direction, amplified intensity. That's the silver multiplier effect. And today's crash? Macro-driven. Both metals fell together, signaling a dollar-driven event, not silver-specific industrial fears. Here's where it gets fascinating. Look at December 30 to 31, 2025. Same crash, panic selling everywhere, sentiment at rock bottom, social media full of doom, people saying the rally was over, and then January 2026 happened. Gold up 30%, silver up 65%, record highs. Panic selling resets markets, shakes out weak hands, and creates buying opportunities for strong hands. This is the hidden rhythm of markets. Crashes are often the prelude to explosive gains. Now that you understand the DXY and why today's crash happened, let's zoom out and see the bigger picture. Gold and silver don't just move because of the dollar, they are affected by global economic trends, industrial demand, and geopolitical shifts. First, China. This isn't just about factory slowdowns, it's about industrial metals demand on a global scale. Silver is an industrial metal first, a monetary metal second. More than 50% of silver demand comes from industrial uses: solar panels, EVs, electronics, semiconductors. Every slowdown in China reduces expected industrial consumption, and traders preemptively sell silver. That's why silver dropped harder than gold. Next, India and Russia. These countries are accumulating gold in massive quantities. Central banks in India and Russia are not trading daily. They are accumulating long-term reserves, often quietly. When retail panics, these institutions are the buyers. They see fear as opportunity. While the US dollar surged today, they quietly snapped up gold at a discount. And then there's the de-dollarization trend. Countries are increasingly diversifying away from the dollar, using gold and other assets as reserves. This is a slow-moving force, but it's real. It doesn't get disrupted by a 60-minute crash. It keeps metals fundamentally strong regardless of short-term volatility. Let's talk about the Federal Reserve, because the Fed is always the elephant in the room. They control interest rates, and rates control the dollar, and the dollar controls metals. Right now, the Fed is hawkish, signaling that rates may stay elevated longer than expected. Higher rates, das stronger dollar, das weaker gold and silver in dollar terms. Simple, right? But here's the nuance. This is forward-looking. The Fed doesn't react to today. They react to inflation expectations, employment data, and geopolitical risk. Markets try to anticipate their moves. That's why we see sudden spikes in the DXY before metals drop. But remember this: interest rates don't change the physical demand for gold and silver. They don't stop India from buying. They don't slow Russia's accumulation. They just change short-term sentiment, creating volatility that scares retail traders. Industrial demand and silver's behavior deserves a special section because it's often misunderstood. Silver is both a precious metal and an industrial metal. That dual nature makes it highly volatile. Take solar panels, for example. Every panel uses silver. Electric vehicles use silver in wiring and electronics. Semiconductors, AI chips, and data centers all consume silver. A slowdown in production anywhere in the world affects projected silver demand and triggers massive selling. Compare this to gold. Gold is primarily a monetary metal, used in jewelry, reserves, and wealth preservation. Its price doesn't fluctuate based on industrial output nearly as much. That's why in crashes tied to industrial demand, silver often falls faster and rebounds faster. Professional traders thrive on this. They accumulate on fear, patience is their weapon, and they know that sentiment always swings back. Today's red candles were a gift to the strong hands, the ones who can watch chaos and think strategically instead of emotionally. Patterns and historical precedent. Let's go back to December 2025, the last crash, same pattern, panic selling, liquidations cascading, sentiment maxed out, social media full of doom. And what happened next? January 2026 exploded. Gold plus 30%, silver plus 65%. This isn't luck, it's market rhythm. Panic cleanses the market of weak hands. Strong hands accumulate, overbought conditions reset. Then the next leg up happens faster than most expect. If you missed that pattern in December, you'll miss it again if you don't pay attention today. That's why historical context is critical. Metals are cyclical, not random. The crash is a setup for the next move. Setting up for predictions. Here's where it gets exciting. After understanding DXY, Fed policy, global demand, leverage, and sentiment, we can anticipate the next moves. There are 3 scenarios. Bull continues. Today's crash is a shakeout before the next leg up. Strong hands accumulate. February starts strong. Gold tests $6,000. Silver breaks $150. Probability 60%. More pain. Fed stays hawkish. China data worsens. DXY keeps surging. Another crash hits. Gold could test $4,800, silver $90. Probability 30%. Chop zone. Markets go sideways. No new highs, no major crash. Retail gets frustrated. Then the real move comes unexpectedly. Probability 10%. And here's my specific prediction. Silver will be back above $120 by February 15th, 2026. This isn't speculation. It's based on pattern repetition, oversold conditions, and the resolution of the US government shutdown drama. Practical takeaways and survival guide. All right, by now you know exactly why gold and silver crashed today. You know it wasn't random. You know it was triggered by the DXY spike, Fed hawkishness, China industrial slowdown, political uncertainty, and leverage cascading liquidations. But knowing why something happened is one thing. Knowing what to do next is where most people fail. Let's break it down. 1. Holding physical metals. If you own physical gold or silver, do nothing. Repeat that, do nothing. Physical metals are insurance, wealth preservation, long-term savings. You do not sell insurance because the stock market is volatile. You do not cash out your savings because metals dropped in an hour. For perspective, silver went from $121 to $108 in 60 minutes. That's 11% down. If you bought silver at $100 last year, you are still up over 8%. The crash does not erase what you already own. It just changes the price on a screen. Don't let emotions make a temporary number into a permanent loss. 2. Trading with leverage, the danger zone. If you are trading gold or silver on leverage, today was your wake-up call. Margin calls triggered liquidations, cascading into a waterfall of red. Your stop loss may not save you. Gaps happen. The higher your leverage, the faster you can get wiped out. Lesson: reduce leverage dramatically or avoid it entirely during volatile periods. The gains might be bigger, but the risk of total wipeout is very real. Today, someone with 10x leverage lost everything in 1 hour. 3. Buying opportunity, the blood in the streets. For those sitting on cash, Crashes like today are the best time to buy. When everyone is panicking, when red candles stack, when social media screams doom, strong hands accumulate. But here's the critical advice. Buy in trenches. Don't go all in at once. Dollar cost average your purchases. If silver drops further, add more. If it rebounds immediately, you've already bought at a discount. Only invest money you can lock up for months or even years. The psychology of the market. Here's something most investors never fully grasp. The market doesn't care about your feelings. It doesn't care if you panic. It doesn't care if you bought at the top. It only rewards those who understand and prepare. Crashes separate the patient from the impatient, the emotional from the rational. Today, $6 trillion changed hands. Some lost it, some gained it. Which side were you on? If you panicked, that money is now in someone else's account, the strong hands. If you stayed calm, you still have the opportunity to recover, maybe even profit. Let's put this into perspective with historical examples. March 2020, gold crashed 30% during the early COVID panic. People sold everything. By August, gold reached all-time highs. Let's put this into perspective with historical examples. March 2020, gold crashed 30% during the early COVID panic. People sold everything. By August, gold reached all-time highs. 2008 financial crisis. Silver crashed 50%. 3 years later, silver rebounded to $50. Every bull market has corrections. Crashes are normal. The difference between winners and losers isn't intelligence. It's emotional control, preparation, and patience. Here's what I'm personally watching and why you should too. DXY, dollar index. When the dollar spikes, metals get crushed. When it drops, metals rally. Simple as that. U.S. government shutdown and political events. Uncertainty drives fear. Watch deadlines. When uncertainty resolves, fear subsides. China data and industrial demand. Any signs of stimulus or recovery? Bullish for silver. Weak data, bearish. Fed statements, hawkish. Dollar up, metals down. Dovish, metals bounce. If you pay attention to these 4 indicators, you can anticipate volatility before it hits your portfolio. Now let's talk mindset. This is the part most videos skip, but it's critical. Patience is your superpower. The market always rewards patience. Fear is temporary, opportunity is long-term. Today's panic could be tomorrow's profit. Plan before the storm, act after it. Don't react emotionally. Have a strategy. Remember, it's not timing the market perfectly. It's time in the market while staying prepared. Here's my final prediction on record. Silver back above $120 by February 15th, 2026. Gold likely to rebound towards $5,800, $6,000 in the same time frame, depending on DXY and Fed moves. Why? Because December's crash led to January's 65% rally, and today's crash mirrors the same sentiment cleansing pattern. Oversold conditions, plus strong hands accumulating, plus fundamentals unchanged. Oz, rebound likely. Here's the ultimate takeaway. $6 trillion changed hands today. Some lost it, some gained it. The difference is preparation, understanding, and patience. If you panic today, reflect, learn, prepare for the next opportunity. If you held, congratulate yourself. You're still in the game. If you're on the sidelines, pay attention. History favors those who are ready. And here's the secret most people miss. This isn't just a market. It's a game of information, psychology, and timing. Learn it, master it, use it, subscribe to this channel, hit the bell. Why? Because the next silver and gold update is coming soon, and you want to be there when the next mega move happens. December crashed, January pumped, January is crashing, February is coming. Don't miss it.